Hello, this is Robert. I'm a tax attorney here at TRP, and we're going to be going over business offer in compromise, requirements to settle IRS business debts, and what the tax relief companies don't tell you. So, a business offer in compromise with the IRS is basically a settlement for business tax debts. The IRS agrees to accept less than the total amount of tax owed as a settlement. These business tax debts could include the following types of taxes: income, payroll, and unemployment. But we find that a lot of the business cases are mostly payroll issues. Getting a business offer in compromise accepted is more difficult than a personal offer in compromise. So most businesses that apply for an offer in compromise have payroll tax debts. Here we'll go through the initial requirements for a business offer in compromise if they have payroll tax debts or they don't. This applies to businesses that are still in business and or corporations, partnerships, multi-partner/owner LLCs, and single-member LLCs. If it's a sole proprietorship business, a disregarded single-member LLC that's taxed as a sole proprietorship, or for any personally assessed payroll debts for a closed business, that's going to be under an individual offer in compromise application. That's not going to be a business application. And what I mean by that is you're going to be using, for those individuals, you're going to use Form 433A OIC as your supporting financial. You're going to use Form 433B OIC for the business ones. So here's the initial requirements. Current compliance. First of all, the business must be compliant. The IRS has eased the compliance rules for business offer in compromises. Previously, a company had to be in compliance for 6 months with their payroll obligations to submit. And now it's really just the current fiscal quarter. As long as current fiscal quarter is good, that requirement is met. We strongly recommend to all of our clients to use an automated payroll service going forward, such as Gusto. The IRS agents like to hear that the payroll is no longer in the client's hands. We've had cases where people are manually doing the payroll, and I've had an accountant that didn't mail something on time, and we had to resend the offer in compromise for the client because the accountant messed it up. Plus, it's just easier, and most of the time, the automated services are cheaper as well. Here's another initial requirement. Satisfaction of personal assessment on responsible individuals or full payment of trust fund recovery penalty. The following must have happened first for a business offer in compromise data accepted. The IRS must have also personally assessed the trust fund recovery penalty to all liable individuals, and the TFRP amount must have been settled in a personal OIC or paid in full. So the base tax amount gets transferred to somebody that's held responsible for it, sometimes more than one person, and then that person can submit a settlement on that portion. But that has to be accepted first, or that base portion has to be paid off before an offer in compromise is submitted. So what is the trust fund recovery penalty? The base amount of payroll tax due assigned to individual, the base amount of payroll tax due that's assigned to individuals responsible for depositing payroll. Usually it's about 60% of the total tax debt, plus minus a little bit. Officers and managers in charge of payroll are likely to get assessed this. Anyone that signs checks might get tagged too. Many business owners are surprised that they can owe taxes for a corporation or LLC. They think, there's no personal liability. But this is not shield liability from the trust fund penalty. This is a way for the IRS to collect on people personally for payroll tax debts. They called it trust fund taxes because IRS sees it as you holding the money in trust for the government. The IRS wants a TFRP cleared up before accepting a business offer in compromise. There are two forms used for an IRS business offer in compromise, and this is what you're going to use. Form 433B, OIC, and Form 656. Form 433B OIC is it's a comprehensive financial statement. It takes a look at the financial health of the business. Form 656 lists basic information about the company, liabilities, and the amount offered. That's the actual settlement form is the 656, and the 433B is a financial statement. 433B non-OIC is used when you're submitting to revenue officers. 433B OIC is used to submit offer in compromise. So here's some statements on qualifying for a business offer in compromise. In order to qualify for a business OIC, the financials also have to make sense. This means the business could not pay back the amounts due based on their income and expenses within the collection statute expiration date. Assets are also done in there as well. So if the business has a bunch of assets worth more than the amount, you're probably not going to get it. Here are some things the IRS will look at regarding the business income and expenses. One, how much money does the business have left over at the end of every month after expenses? If nothing or the business is losing money, this helps. They'll also see if the expenses are reasonable. It can't just be totally unreasonable. If company officers receiving large sums of compensation while they're responsible for the tax debt, the IRS is less likely to accept a business offer in compromise. Someone could pay themselves $1 million and have a company that makes $1,001,000 in profit, and they could say the company makes $1,000 in profit. Probably not going to get an offer that way. If the business can sell assets to satisfy the debt, An offer in compromise acceptance is unlikely. Exceptions can apply to this rule. The IRS would probably not require a mechanic to sell their tools or a gardener to sell their truck, to get an offer in compromise. But in general, assets more worth more than tax debt is not a good chance. If the business is in a bad financial situation, is it temporary or long-term? The IRS will look at prior income to see if the business is just in a temporary slump. If so, they may not accept an offer in compromise. In recent years, the IRS has been much more lenient on this rule, though, and they aren't looking to the past as much as they were. So, reasonable collection potential business continued. The IRS is looking for a reasonable amount to collect based on the financial health and assets of the business. They call this the reasonable collection potential. If the RCP is equal to or higher than the balance due, the business offer in compromise acceptance is very unlikely to get accepted. There is a good chance of acceptance when the reasonable collection potential is equal or less than the offer amount. Business offer in compromise are possible, but they are difficult. Business offer in compromise is much more difficult than the personal because there's more variables in it. The requirements are stricter, and the IRS is tougher on acceptance. In order to get your best chance at acceptance, it's probably best just to hire an attorney to do it. If you would like a free no obligation consultation with one of our tax attorneys, just give us a call at 888-515-4829. Again, that's 888-515-4829, or go to our website, trp.tax. That's trp.tax, and we'll get you some help.